here we go. I think we can start. Okay. 2 minutes early even for me. I'm so sorry. Let me excuse myself again. There was some miscommunication. I was convinced that we would start at 2 o'clock my time, so at 8 o'clock your time apparently. So it's very late at night for you. I'm really sorry. Okay, so we have only 2 hours now, so it's going to be a short introduction. So this is an introductory course on commodities. Apparently, I don't know if you have had Didier Marteau's class, where I think he already talks quite a bit about commodities. So if there is some repeat or maybe even some contradictions, you have to tell me. I like to have a class where I exchange with everybody. So I cannot see you, at least not at the moment, but if I would really appreciate if you could jump in and interrupt me and ask questions. Okay, if there is some clarification or maybe some additional things that you would like to know about. Again, I'm really all for having interactive class. It's not obvious online, I know that, but otherwise you could just watch a YouTube video, no? So the advantage of having a real professor on the other side of the screen is to be able to ask questions that you cannot do in a YouTube tutorial. And that's why I'm teaching, and that's why I'm not running simply a film of myself. Okay, so that's just for the beginning. So commodities and commodity futures. So it's not a class on commodity markets. It's a class on commodity finance. Now, of course, when we talk about commodity finance, we have to talk a little bit about commodity markets as well. But we will not talk too much about, how do you trade oil or how you transport wheat. All of these things are not part of the class. What we will mostly talk about is how to trade financial derivatives, so financial instruments with values that depend on commodity prices. Okay. And that will be mostly commodity futures and a little bit of options. And then we'll discuss how we can use these commodity derivatives to implement arbitrage strategy. First of all, to make bets on commodity prices. What do you need to buy if you think that, I don't know, coffee prices will increase? What do you need to buy if you think that wheat prices are going to decrease? What do you need to buy if you think that wheat prices are going to decrease in 1 year, but will first increase? So we'll talk about these trading strategies that you can implement using financial instruments, but placing bets on the movement of commodity prices. Okay. So we will talk a lot about these commodity futures. And in the 5th session, at the end, we will also talk about commodity funds. So commodities as an investment product. How can you invest money in commodities? And again, if you do this, normally you do not directly invest the money into the commodities, but you invest the money in financial contracts, the prices of which depend on commodities. Okay, so here you have a plan for our 5 sessions. So only the first session will really be about what are commodities and how to trade commodities, and then we start talking about commodity markets. Okay, commodity derivatives. Okay, so let's go to the definition of a commodity. What is a commodity? The joke is that a commodity is something that hurts you when you drop it on your big toe, or something that smells bad if you leave it out in the sun for too long. Okay. Well, it's actually mostly correct, okay? So commodities are input materials, okay? But actually there are some commodities that, you cannot drop on your toe, and some commodities that do not start to smell bad if you leave them in the hot sun. For example, natural gas or electricity or even shipping capacity. These are today considered as commodity markets. Okay, so a better definition is actually a generic, largely unprocessed good that can be processed and resold. Okay, so commodity is something that exists in large quantities. Okay, and that everybody knows. And all of these goods have the same characteristics. And commodities, of course, are normally not sold as such, but are used as input materials for more advanced production processes. Okay, homogeneous, standardized, easily defined. Okay, so in the US, for the purpose of US commodity exchanges, you have here the list of commodities. Okay, so these are actually the products on which you're allowed to trade commodity derivatives. So it's a whole list. I mean, wheat, cotton, rice, corn. So these are the classic commodities. Then you have stuff like livestock. Livestock are living animals, cows. Livestock products, these are the famous pork bellies, for example. That's a famous commodity in the US. But you can also have, motion picture box office receipts. Okay, that's also a commodity. Why is it in a commodity? Because people want to trade on these things. They want to define derivative contracts on that. And if it is defined as a commodity, it's going to be subject to different rules than if it is defined as a financial derivative. So, for example, a derivative on stocks will not be considered as a commodity derivative and will therefore be subject to different regulations in the US, whereas a derivative on motion picture box office receipts, okay, will be considered as a commodity and therefore regulated by commodity rules. It's quite absurd, but that's American financial regulation. So you have separate regulation for financial markets and for commodity derivatives. Of course, commodity derivatives should be considered as financial markets as well, but they are not regulated by the same authorities, and they don't exactly apply the same rules. It's something that's going to be interesting later on, because a lot of the things that you think are true in financial markets are not true in commodity markets or commodity derivative markets. For example, insider trading is forbidden in financial markets. It's allowed in markets for commodity derivatives. Quite surprising. Okay, and another interesting fact is, for example, that onions in the US are not considered as commodities. So you're not allowed to trade a derivative on onions. Why not? Because this existed until the 50s. Okay, and then they had a big bubble in onions and a big crash in onions. So onion farmers got very angry, and they lobbied the US government to make it impossible to sell financial contracts or derivatives on onion prices. So they removed onions from the definition of what is a commodity. And since then, actually, you cannot trade onions anymore on a futures exchange. Okay. So what is interesting is also that interest is included, which means that actually derivative contracts on interest rates are not regulated by the financial regulator, but regulated by the CFTC, which is the commodity regulator. But this is something we'll talk about later in more detail. But these are the intricacies of US financial regulation, some quite surprising and quite unlogical regulations here. But here you have what is normally considered as a commodity, and you have the big groups of commodities. So you have the softs, and you have the hard commodities. Okay, so within the hard commodities, so these are not all hard, you have the energy and the metals. Energy is, as you can see, different types of oil coming from different origins, coal, gas, and gasoline. Okay, so there are more, but these are the principal energy contracts. Then you have the metals. So in the metals, you have the industrial metals and the precious metals. And you have the list here. I mean, as the name indicates, industrial metals are mostly used for industrial purposes. Precious metals are also often used for industrial purposes, rhodium, osmium, and so on. These are rare metals that are used in computer chips, for example. But gold or platinum, of course, or silver, these are metals that are mostly used for jewelry, so precious metals, or that are used as a means of payment. Okay, so that's the hard commodities, energy and metals, and then you have the soft commodities, and in the soft commodities, you have the agricultural commodities and livestock. And livestock, as I said, is living animals that in the US are considered as a commodity, and on the prices of these living animals you can have, and we will see this later in more detail, you can have financial contracts. So you have two types of cattle, feeder cattle and live cattle. Feeder cattle are the young cows that you have to feed so that they grow. Live cattle are the cattle at the stage when they can be slaughtered for meat. Then you have hogs, the live hogs. Hogs is a pig. And you have pork bellies, as I told you, my pork bellies. This is just, I don't know what's the English term. Okay, this is just the fat from the belly of a pig. So that's the livestock, living animals. And then you have the grains and seeds and softs. So softs is coffee, cotton, cocoa, orange, rubber, sugar, silk, timber. I'm not sure why timber is considered to be soft, but it's part of timber is wood, and wool. And in the grains and seeds, you have the famous wheat contracts and corn contracts and soy contracts. These are the big contracts, and then all kinds of less widespread grains that are used for human or animal consumptions. Okay. Now, I told you we would talk a little bit about trading in commodities. So in terms of world trade, in terms of value, commodities are not a big part of the world trade. 14% if you exclude oil, basically, or gas, energy. 23% if you include oil and gas. So most of the value of trade is in actually manufactured products or services. But that's because commodities are relatively cheap compared to manufactured products. If you look in terms of volume, for example, commodities have 80% of the volume of world trade, but only 23% of value. So most of the actual commodity trade, where grain or oil or live cattle are, transported from one country to the other, most of this is actually done by a list of commodity trading firms that are extremely famous, extremely profitable, but extremely secretive. So if you look at this list, this is the list of the largest commodity trading firms. One thing that is quite striking is that most of them are listed or are headquartered in Switzerland. Okay, Why are they headquartered in Switzerland? Because if you are headquartered in Switzerland, you don't need to tell anybody what you're doing. Switzerland is a very secretive country, and you have no publication obligations. There's, of course, a second advantage of being in Switzerland, which is that you don't pay a lot of taxes either. But I think that's not the major advantage. The major advantage is that nobody knows exactly how much these companies are earning, and nobody knows exactly what these companies are doing. And that's why they want to be in Switzerland. So you have a lot of them that are in Switzerland, and then you have a couple of US firms, okay? And then you have a Chinese firm, Noble Group, and you have Louis Dreyfus, which is a French company, but it's headquartered in the Netherlands for tax reasons. Okay, in France you have to pay a lot of taxes, and if you have a very profitable company, then you want to avoid that. So you go to the Netherlands, which is very close and has much more interesting tax laws. So very secretive firms. And these secretive firms today intermediate most commodity transactions. So historically, big companies would directly buy the input materials they needed from the producers, but today most of the big companies, they don't source their commodities directly from the producers, but they buy them from these large commodity firms, and the entire trading and acquisition and collection and quality control and so on is all carried out by these commodity traders. So these commodity traders, they own, very often they own the ships, of course, they own the ports, they own the storage facilities, sometimes they own infrastructure, okay? And more they are also turning into producers. So they are, and historically they have only transported the commodities, but they start buying the mines, for example. So they get invested also in the production of commodities, or the extraction of commodities, if you talk about mines. And they do also a lot of trading in these commodity derivatives. So they carry out very complex arbitrage operations where they arbitrage between commodity prices in different locations, or what they think will be the evolution of commodity prices over time, and then they can combine their knowledge of what is going to happen with the commodity prices with financial derivatives on the commodity prices to lock in profits. Okay, so they are very important as part of the world economy, but extremely secretive. It's extremely complicated to find out exactly what these firms are doing. But most of the world's commodity trade is somehow flowing through one of these big commodity trading firms. Now, as an example, maybe I can talk about Glencore, and also to get you an idea of how they are not high reputation firms. So let's say it. Let's put it this way. So Glencore has been founded by Mark Rich. Okay, who was not very rich when he founded the company, but became very rich after founding the company. And Mark Rich is famous because actually he was the first one to go to Switzerland, and the reason he went to Switzerland is that he would have been arrested in the United States. Here you have the story. Okay, in 1983, so he founded Mark Rich & Co. in 1974. That's the predecessor firm of Glencore. And he was criminal convicted in 1983 on 65 criminal counts for tax fraud and also for trading, for violating the sanctions with Iran. And so he escaped from the US because he would have been put in jail in the US. and he moved his company to Switzerland. And that started this entire trend of commodity firms going to Switzerland. In Switzerland, tax fraud is not considered, at least tax fraud with foreign countries is not considered a crime. Okay, so if you are, escaping taxation in another country, you can go to Switzerland, and Switzerland will not, extradite you to, for example, in the US. So the guy even had a 500,000, half a million, reward on his head. Okay, so in theory, you could have gone to Switzerland, arrested the guy, and brought him to the US. He would have gotten $500,000. It never happened, and actually, that's the most important scandal. He was pardoned by Clinton. So you know that American presidents, when they resign, okay, when their career is over, the last thing they do is they pardon a lot of people. And in 2001, Clinton ended his presidency and he pardoned this very famous guy, probably because the Democratic Party had received a lot of money from him. Okay, so the origin of Glencore is really not, highly reputable. But today, this is one of the biggest commodity traders with a net income of 2.6 billion and 160,000 roughly employees. So a massive, massive company listed on the stock exchange in London, but headquartered in Switzerland. And I mean, not surprisingly, you have repeated scandals. Here's just a small list of all the problems, all the legal problems they had. I mean, they don't seem to have changed a lot from their behavior when they were founded in the 70s and when Mark Rich was sent to jail. Well, not sent to jail, but was condemned to jail. Now, what is the biggest problem in terms of corrupt practices? And why do they absolutely, or many of these companies, need to be registered in Switzerland? Now, if you look at these are statistics that are produced by, I think, the IMF. So, and this is about Zambia. So Zambia is an African country that produces a lot of copper. Okay, and you can see that this is the copper export to different countries. Okay, so you can see that historically they're close to South Africa. They exported almost all their copper. They exported almost all their copper to South Africa or the UK, because, I mean, that's their former colony. But then in 2005, they started to export almost everything to Switzerland, okay? And increasingly to China, okay? Now, does the copper really go to Switzerland? Of course not, okay? The Swiss don't need, what is it? It's it's millions of tons of copper. It's a percent. So 60% of the copper exports they go to Switzerland. Do the Swiss need all this copper? No, the copper never arrives in Switzerland. It's just that the ownership of the copper is transferred to Switzerland. Okay. Now, why is the ownership transferred to Switzerland? This is related to this graph. So here you can see the difference between so this is the difference between the copper exports and the copper imports. So this is the copper exports to the world. Okay, let me see. Now I'm not sure that this is the right graph. Okay. Well, this is about misinvoicing. So what does misinvoicing mean? It means that actually the copper is sold for a very low price to this company in Switzerland, but and then sold for the market price again by this company. So the company makes a huge margin on this transaction. So again, the copper doesn't really move physically, but the ownership of the copper is first transferred, for example, to Glencore, and then Glencore sells it on to whoever needs the copper for the industrial production. Okay, why does the Glencore earn such a huge margin? But actually, the copper is sold by local politicians or by some probably corrupt mine managers at a price below market value because this guy will recover part of the margin. Okay, so you will sell the copper at 80 to the Swiss guy will sell it at 100, but actually 10 out of the margin of 20 will end up in the bank account in Switzerland of whoever agreed to sell the copper for a too low price. Okay, so in other words, the reason for why they have these firms in Switzerland is that the margin is realized in Switzerland, and because a lot of these corrupt country officials have bank accounts in Switzerland, it's very easy then to transfer part of the margin to the private bank accounts of these officials. Okay, so it's a pretty fishy business, and I'm not saying that everybody does this, but it's well known that this is part of the problem in commodity markets. The countries that are exporting these commodities, unfortunately, do not benefit a lot from the export. A lot of the value is actually captured by some officials and not by the country as a whole. Okay, and actually this is called the resource curse. Maybe you have heard about this. This leads to the development of very authoritarian governments in a lot of countries that have these that have lots of commodities. So it's simply too easy to steal these commodities and then use the money to basically defend yourself against anybody who tries to prevent you from stealing this money. So, I mean, this is clearly what happens today in Russia. And that's probably the reason why Putin can also finance this war. Most of the money that is made by Russia's massive oil exports, I think they export something more than 100 billion of oil every year. All of this money never reaches the Russian population. All of this money is basically captured by a very few people in Russia, and they use this money. Part of it they use it for themselves, and the other part they use it to make sure that nobody, prevents them from continuing to steal this money. And you have seen similar mechanisms in Venezuela, of course, and in Saudi Arabia. All countries that have a lot of oil, and all countries that over the last couple of decades have moved from relatively open, relatively democratic societies to very repressive, very brutal regimes. And the reason for why these brutal regimes have been able to survive is that they are financed simply from these resources. Okay. The only exception is actually Norway. Okay, Norway is a big oil producer, and in Norway, the politicians, they don't steal the oil or the money. They invest it in a sovereign wealth fund. So the country owns an investment fund that today has 1.3 trillion in assets. So a one with so a trillion has 12 zeros. Okay, so this Norwegian wealth fund today has a value of $250,000 per inhabitant. Okay, babies and everybody included. Okay, quite impressive. So you should try to become Norwegian. If you become Norwegian, you will have the right to use 250. No, you cannot directly get the money, okay, but the Norwegian government has money that is worth $250,000 per citizen. Okay, just imagine, I mean, in Russia is a much bigger oil exporter than Norway, and in Russia, the average citizen owns something like $5,000. Okay, so you can see the amount of money that has been stolen by the political system in Russia, and you can imagine how developed Russia would be today if there was not this problem of the resource curse. Okay. Okay, I mean, of course, Norway, they discovered the oil in the 70s, so they discovered this very late, and at the time they were already a very stable democracy. In Norway, it was not with a very strong legal system, so it was just not possible, and with a lot of transparency. It's a very small country also, a lot of transparency. It was not possible to steal the money, and that's why they developed this sovereign wealth fund, which is now the envy of everybody, because I mean, it would be nice to be Norwegian and have $250,000. So the theory is, of course, that countries that have wealth that is based not on, natural resources that can be easily stolen, but wealth that is based on human capital, that these countries need to develop more inclusive governance structures. Okay, but the jury is still out on this theory, I guess. I mean, so I think there are a lot of countries that are today, evolving towards a more authoritarian structure. And it's not obvious whether their economies, if the economies are based on human capital, personal investment of people, innovation, it's not obvious that these countries will continue to perform very well if they head more towards these authoritarian structures, because in these authoritarian structures, individual initiative, individual wealth creation is strongly discouraged, because in the end, that if you develop a lot of wealth, if you put in a lot of effort, in the end, it might be taken away by the government. So you don't have really incentives to become very entrepreneurial. Okay, so that's the resource curse, and that's really related to these big commodity trading firms that help countries I'm oversimplifying, but that help a lot of people in these countries to steal the resources of the country. I mean, commodities also have, countries with a lot of commodities also have other problems. So a related but less severe problem is the Dutch disease. So what is this about? This has been discovered the first time in the Netherlands, which in the 50s discovered a huge natural gas field. Actually, they have closed it since, but now they want to open it up again to replace the Russian gas, of course. So in Norway, when they discovered this gas and started to sell it to other European countries, but there was a lot of money flowing into Netherlands. And at the time, Netherlands had their own currency, so this currency increased a lot in value. But now, if the currency increases a lot in value, the salaries everything becomes more expensive for the countries around. So that made it very difficult for Dutch companies that were not related to the gas industry to prosper. So this high exchange rate basically drove a lot of other companies out of business, and in the end, basically destroyed the economic growth in Norway, because most of the growth was driven by simply the exploitation of these natural resources. We know this effect from other countries. And some people even say, so I have a couple of examples down here. Some people even say that you have a problem like this in the UK today, you may know that a lot of the economy in the UK is based on financial services. And given that financial services are so important, the pound is very expensive. And that means, of course, that the UK industry is performing much less well because they are basically crowded out by this overwhelming force of the financial industry, and they cannot compete internationally with these high exchange rates. And the pound is, I think, I mean, in terms of purchasing power, if I take my money, my euros, and I buy something in Paris, or I, exchange it into pounds and I buy something in the UK, my purchasing power in the UK is lower than my purchasing power in Paris with the same amount of money in euros and then translated into pounds. Okay, so that was my brief explanation on the political environment of a lot of commodity markets, and it's very opaque. A lot of these markets are very opaque, and there's a lot of things that go on in these markets that are maybe not really, good for the economy or good for the countries. Anyhow, but the last thing we're going to say about this, okay, then we're going to talk about more technical things. Now, what about commodity prices? Okay, so there is one theory, it's called the Hotelling theory of commodity prices, and it says that in principle the price of an exhaustible resource, okay, and most commodities are exhaustible. Let's think about gold. I think almost all the gold that is available in the Earth's surface has already been extracted. So there's much more gold today in in central banks than it's left in the ground. So that's an exhaustible resource. At some point, you cannot extract any more gold, or oil or coal. Okay, but the price of these commodities should rise over time. Okay, at a rate that is equal to the interest rates, the real interest rates. Okay, that's the Hotelling theory of commodity prices. And the intuition is quite simple. Okay, the intuition is, what would a guy who owns a commodity mine, okay, so let's suppose you have a coal mine. I mean, coal is maybe not a good example because we clearly cannot burn all the coal that's in the ground. Well, let's still use coal as an example. Okay, let's suppose we can burn all the coal that's in the ground. Let's suppose you own a coal mine. Okay, now you don't need money now, you need money in 1 year. Okay, now you have two strategies. You can either extract your coal now, sell it, and put the money in the financial markets, and if you do that, you will earn the interest rate. Okay, and after 1 year you will have the price of the coal today multiplied with 1 plus the interest rate. The alternative strategy is to leave the coal in the ground, okay, and sell it next year. Okay, and then you will again have money next year, but the money you will have next year will simply correspond to the price of coal at the end of next year. Now, in equilibrium, okay, you should be indifferent between the two strategies. Okay, why? Because if interest rates, I suppose interest rates are very high, and let's suppose you think that the coal prices will remain stable. Okay, what would be the best strategy here? And actually, I should ask you the question and check if there's still somebody on the other side of the computer screen here. Okay, is somebody still listening here? Apparently not. What is this? What is the best strategy for somebody who owns a coal mine and in a country that has very high interest rates? Should he extract the coal now, or should he wait and extract the coal next year? So there's a discussion. Okay. Up. Okay, let me try to reformulate the sentence. Okay. Coal mine owner, okay, faces high interest rate. Extract now or extract later? Let me see if somebody reacts here. I've been speaking on my own for, what, 40 minutes now? So I think it's time for you to say something. But for some reason, I cannot hear you, huh? Is it because I switched off the mic? I don't think so. I think it's because you don't talk, huh? And as I told you, I mean, if you don't interact, then you might as well watch a video. Huh? So if you have high interest rate, you say, thanks a lot for this written reply. Next time we try to talk. But you're right. Huh? If interest rates are high today, but you think that the price will remain more or less constant, but then you will have more money tomorrow if you just extract the coal and you sell it today and you invest the money in the market, and then you have, a high amount of money because of the high interest rate. Okay, so you're right. If you have high interest rates and you think that the coal price is remaining flat, then you should extract the coal now. Now, if everybody makes the same operation, what will happen to the coal price? But if everybody has the same reasoning, everybody will extract coal now and will try to sell it today and put the money into the financial markets. But if this happens, the price today will go down. Okay, and when will people stop to extract the coal? They will stop extracting the coal when they think that the price has gone down so far that actually it might be better to wait and extract and sell the coal next year, okay? Because next year's price will be better, okay? So that's the Hotelling argument, okay? The process will stop when everybody anticipates that the price has gone down so much that it's better to wait next year, okay? Because actually the increase in the coal price, okay, from this year to the next year will be the same as the increase in the money that you could get from extracting and selling the coal, okay? So you have an equilibrium reasoning, okay? Unless the interest rate is, if the interest rate is higher than your expected increase in the coal price, your best strategy is to extract the coal now and sell it, okay? If your anticipated increase in the coal price is higher than the interest rate, then nobody should sell any coal anymore, okay? You should just wait until the coal price goes up and, extract and sell it at the higher price. But if that happens, of course, then there will be no coal supplied to the market today anymore, and then the coal price today will go up. And if the coal price today goes up, the increase in the coal price will be lower. And again, this process will stop when the anticipated increase in the coal price is exactly the same as the interest rate. So that's our reasoning, and that's this Hotelling theory that says if you have an exhaustible resource, the best thing to do is to extract the resource if interest rates are higher, and not extract it if interest rates are lower than the anticipated increase in price. And that, of course, leads to a situation where the anticipated increase in price is exactly the same as the interest rates, okay? So on average, if these anticipations are correct, because investors are not stupid, we should see that commodity prices go up at the same rate as the interest rate over time, okay? Now, what we see in practice is unfortunately, or maybe fortunately for the economy, exactly the opposite. What we see in practice is that commodity prices, or overall commodity prices, are going down over time. Okay, and in particular, if you exclude coal and oil. Okay, so that's the red line here on our graph. It gives you the average evolution of 9 different commodities since the mid-19th century until 2000, and you can see that there's a very clear downwards trend. Not a regular downwards trend. Sometimes the prices are jumping, like in the late 40s. Okay, some like in the last financial crisis, but actually it's a pretty steady downwards trend. And it turns out that this trend, if you try to find out what is the long-term performance of commodity prices even further back, you see the same picture. So here we go back until the 17th century. We have 1650 to 2010. And again, it's a very, I mean, at this distance, the decline in prices is really quite surprising. So it's exactly the opposite from what Hotelling, with his quite simple idea, was postulating. And why you have this difference is actually not clear. It's not clear. It could be that the extraction costs are just decreasing all the time. It becomes cheaper. I mean, imagine gold mining in the 19th century. I mean, you had no airplanes. You had to go to Alaska. Alaska was extremely dangerous. So, I mean, gold mining was an extremely expensive and extremely dangerous process. Nowadays, you have your airplanes. You can go to Alaska. You have your cars. So it's much more efficient. It's much less costly to extract the commodities. That's presumably what's going on, and that's the reason for why we have so far, and even in the long past, seen a decline in commodity prices. But I mean, from time to time, people make the argument that this cannot go on forever, and that at some point it's an exhaustible, a lot of resources are exhaustible. There's only so much oil in the ground. There's only so much gas in the ground. There's only so much copper in the ground, and copper is maybe it would have been a better example than coal, because copper, there's a lot of copper that's being needed, and the resources are very limited. Phosphate is another example. Okay, phosphate is a crucial ingredient for fertilizer, as you may know, and the world phosphate reserves are clearly not going to last forever. So at some point we might see that this long-term trend inverts, and that commodity prices go up again, as you would expect with this Hotelling theory. But so far the Hotelling theory is contradicted by the facts. Okay, now of course in recent times we have seen a strong increase in commodity prices, even before the war in Ukraine. I mean, the war in Ukraine is going to be a disaster, as you may know, for food prices, because 25% of the world's wheat production is coming from Russia and Ukraine. And in Ukraine, it's very unlikely that they will be able to plant wheat. Though, I mean, if you want to plant wheat in Ukraine, we have to basically end the war in 1 or 2 weeks. It's not impossible that this is going to happen, but it's not likely. And if the war is going on for longer than that, we will lose 15-20% of the world's wheat production. And if we maintain, of course, the sanctions in Russia, we will lose an even higher fraction, because Russians will plant wheat, but we may not be willing or able to buy the wheat, because we have exposed sanctions, Russia to sanctions. Okay? So what I wanted to do is I wanted to play around a little bit with Bloomberg and just check a recent commodity price evolutions on the fly. So I'm at the moment starting the Bloomberg terminal here on my computer, and then we will I will share the screen and we will try to figure out what happened in the last couple of weeks and days with commodity prices. Okay, so give me a minute because it's quite complicated. Several steps. It's such an expensive program that they really want to make sure that nobody cheats. So I have to do a lot of steps to log in. I have to swipe my finger and everything. Let me see if this works. Okay. Try again. I'm sorry. Okay, let me see if this works now. Okay. Sorry, I have to switch on this screener and then I have to synchronize it with the Bloomberg terminal. And now I think I'm done. 5QGA, 5QGA. Okay. And now it works. Okay. It's starting. It's going to take some time. And then I will share my screen. And then you can tell me what you would like to look at in terms of commodity prices. I think we should start with the wheat price because that's clearly the one that has seen the most important. Yeah, I'm not surprised. Okay, it's gonna come back. Don't worry. And talk to me. You can really switch on the mic. Huh? Yes. So let me see. How do I share the arrêter le partage? Okay. And now I'm trying to share the Bloomberg terminal with you. Okay. I think I will just share the entire screen. I think that's the simplest way. Okay. Do you see the Bloomberg terminal now? And let me see. Okay. Only black. Do you see the terminal? Okay. Now you don't see it because now you should see it. The problem I cannot see your messages. I can only, now I can see both of it, but when I open the Bloomberg terminal, okay, somebody's writing. Okay, that's good. Only black. Yes, Prof. Okay, so that I see Bloomberg. Okay, great. So you see Bloomberg. Okay, good. So that's the Bloomberg terminal. I'm not sure if how much you're familiar with that. This is the biggest supplier of information on finance, but also on commodity markets. Very, very, very expensive. Okay, even for universities. And actually, in terms of data quality, the researchers are not happy about the data quality of Bloomberg terminals. Okay, but let's look. Okay, let's look at the wheat price. Okay, commodity wheat. Generic wheat, okay? So W1, what's going on? There's some nonsense going on here. So this is the Bloomberg Messenger. This I don't want, I just want the Bloomberg terminal. Okay, wheat. Okay, here we have the generic wheat contract. Okay, so this is the wheat prices. And here we have the price history. Oh, so apparently, so quite impressive, huh? So this is 2001, 2022, 2021, 2022. You can see the prices actually have recovered quite a bit. Huh? So they seem to assume that the war is going to end, okay, before the special military operation. I'm sorry, I'm not sure I'm supposed to say war. The special military operation is gonna end before the start of the planting season, huh? Because prices have clearly recovered from this huge spike. Okay, or potentially they think that other countries can catch up and can increase the planting surface. I mean, wheat production is very cheap in Ukraine because salaries are cheap, because the ground is very fertile, so you can produce a lot of yield with small surface. So it's a very efficient wheat production. But given that the price has almost doubled. I mean, if you look at the end of 2021, it was a 600, and now more than doubled actually. Given that the price has more than doubled, of course, farmers in other countries where it's maybe more expensive to produce wheat, they have now realized that planting wheat could be a good idea. So this will increase production. So probably both effects have led to the wheat price recovering a little bit from its massive spike, but clearly at the end of February, no, actually in the beginning of March, so end of February, so the war started actually end of February, but initially apparently the market thought that it would be over very quickly and they would, just plant wheat under Russian control. Actually, it spiked it spiked in the first week of March, and then it recovered. Okay, so that's the wheat price. We have another piece of information here, which is the open interest in wheat contracts, and that's something we'll have to talk about. You can see these very strange patterns and this is about the number of future contracts on wheat. So, and actually you can see that the trading on future contracts starts in December, and then it spikes, and then actually it goes down over time. But that's something we'll have to talk about in detail later in class. Okay, so that's wheat. What else do you want to know about? What other? So of course there's a couple of commodities that are extremely important for Vietnam. So that's coffee. So coffee, we have Robusta. So of course the Vietnam coffee is mostly Robusta. So let's see what happened to coffee prices. I think they also increased quite a bit. So this is we will look at all this information, but for the moment we are really mostly interested in the prices. Wow, Vietnam is going to be rich. This is quite impressive. Coffee prices have not quite doubled, but almost doubled since April last year, and now recover a little bit. That's going to make a big difference, and that's going to make a big difference in Vietnam. Okay. And that's Robusta. Maybe we can check Arabica also, coffee. So that's the Vietnamese. So as you know, the most frequently consumed coffee in Europe is Arabica. But history, what's going on here? This intraday, same thing. Even more impressive actually. Went up from 120 to 260, so more than doubled, and now it's recovering a little bit. I don't know what is the reason for that. Probably you know more about this than I do, but that's quite surprising. Okay, rice, you're saying. Okay, let's see what are the rice prices. Okay, generic rice. Okay. Actually, I mean, commodity prices have been increased. So that's the daily. Oh, that's interesting. Also upwards trending. Actually, most commodity and most food stuff commodities have been increasing. Let me look at the longer time frame. Have been increasing since the mid of 2021. What is going on now? Okay, let's see it. But okay, apparently rice has been more expensive in the past, at some time. Why can I not get this is the rice prices. So there has been a huge spike in rice prices at the end of 2020. That I didn't know. And generally, okay, it has been increasing with quite regular patterns. You can see that there's a seasonal pattern going on, and here again is the open interest. But this is something we'll have to talk about in in more detail later. Let's Hevea, okay, rubber. It's traded in. Okay. No, that's not. Oh, I'm not sure we have a Hevea rubber. Oh, maybe it's under rubber. Okay. Ah, it's rubber. Okay. No, less obvious, huh? It's going up and down all the time. So if you are having a Hevea plantation, no, but still, I mean, but no, yeah, it's not a very regular trend here, huh? So mostly foodstuff, huh? Mostly foodstuff is increasing, and Hevea prices are extremely volatile. Huh? It's very surprising, 150 to 350. I wouldn't have thought that. Okay, let's look at, so these are all agricultural commodities. Let's also look at some metals. Okay, so copper. What about copper? Right, well, we go to the line chart. Trending upwards, but not all that much. Huh? And I wanted, but there was a big increase in, so this is now a very long time series, okay? So I'm not good at Bloomberg. So now I suddenly switched to, so it went up a lot in the last financial crisis at 2008, 2007 to 2008. But there was a general commodity boom then. And actually it has remained very high since, okay? So it was actually at $60 per ton, probably. We have to, I mean, again, we look at this into more detail, and now it is at 440, but a massive spike actually also in the last couple of years. So here, okay, so we can look at let's look at an index. Okay, so we looked at individual commodities, and we have seen that actually a lot of these commodities are going up in the last couple of years. People think that this is not related to the fact that these commodities are expiring, or not related to the hoteling theory. It's related to inflation. It's related to the fact that central banks have been pumping money into the system for a long time, and one way this shows up is in commodity prices. Goldman Sachs commodity index. Let's see. Here we go. Okay, so Goldman Sachs commodity index. Yes, this one you should take. Though this is a big, again, this is something we'll talk about in more detail, but this is a tradable index. Oh, that's bad. That's a tradable index that you can use, for example, invest money in commodities. You can invest it in a fund that replicates the Goldman Sachs commodity index. And the weighting, so there's all commodities in there. There's, agricultural commodities, metals, and so on. But the weighting reflects, or supposed to reflect, the importance of the market in the global economy. So rice and wheat and soy, of course, are very important. And that is a pretty impressive pattern. So we have seen a strong increase since December 21, actually, unrelated to the war, and then we have seen this spike. But apparently, the spike has calmed down now, similar to what we've seen in the wheat market. In the wheat market hasn't completely disappeared. But overall, this is, I think, that's inflation. That's inflation. I mean, the prices are expressed in dollars, and the American Central Bank has put a lot of money in the markets, so it's not surprising that the markets, that prices go up. So here you have somewhere, you should be able to find the components of the index. constant complement. Okay, member waiting, so it's probably here. Not available for this index. Okay, so I'll find it out. I'll not look into this now. But I wanted to give you an idea of overall evolution of commodity prices. So at the moment, we are clearly not in in a situation where as in the same situation as in the last what was it, 500 years, 400 years, where commodity prices continuously decreased. At the moment, we are clearly in a situation where almost all commodity prices are going up. How much of this is inflation? How much of this is fundamental demand? How much of this is a restriction of supply, such as in the case of wheat? These are big questions, and these are difficult to answer questions. Okay. So we'll play around more with Bloomberg later on when we look at the details of these different contracts. But let's finish with the global commodity markets. So one striking feature of commodity markets is the importance of China in these markets. So here you have the fraction of the world demand for certain commodities that comes from China. So the last data from 2017. So this is obviously before the Chinese property bubble bust. Okay. And at that time, you can see that, for example, iron, okay, iron was the 70% of the world's iron demand came from China, okay. Iron is, of course, mostly related to construction. That's where you need you have iron also in cars, but the big quantity of iron is, the iron you need for building high-rise buildings. I would suppose that this, let's check the iron prices, okay, just for the fun of it, because given that iron ore, I don't want iron ore, I want steel. Let's do steel. Okay, here we have it, hot rolled coil. So that's a big coil, of steel, GP. Yeah, I mean, what's going on here is obvious. This is the Chinese construction bubble exploding. Okay, so steel prices are divided by half. Can you see that? Very impressive. Okay, and that's because today probably China has less than 70% of the world's steel demand. Steel must be somewhere here as well. Don't have it here. Steel. Okay, steel is here. So 50% of the steel demand came from China. Okay, so iron ore. So okay, iron ore. Let's check iron ore, but presumably the same iron ore, the same pattern. Active contract. Here we go. Yeah. Okay, now so the market crashed before, but it's still pretty low compared to what it had been before in the late 21s. Let's look at the very long-term graph. Apparently they don't have very long-term data here. That's a problem with Bloomberg. So Bloomberg has only Bloomberg is only what's going on. Okay, no, it's only used by traders, and traders are not interested in anything that exceeds the last week. So 20 years. I should have 25 years of steel data here. No, it doesn't work. Okay, whatever. Okay, so but luckily not all commodity prices go up, but the ones that are commodity prices related to construction apparently are not increasing, and that's not surprising. But almost everything else is increasing. Okay, so is this the inversion of this long-term trend? Not clear. actually, we had the same situation already. You can see it here at the end of the 2000s, when the last financial crisis triggered a huge but very short boost in commodity prices. It lasted about a year. All commodity prices were going up. A lot of people were investing money in commodities, and then it came all crashing down. Of course, I mean, the fact that a lot of agricultural commodities increased over this time, 2010, 2011. Why did the agricultural commodities increase? Because a lot of so there was no crisis in, there was no war in Ukraine, there was no, dry period. So supply actually of wheat and other agricultural commodities was quite high. What happened is actually that a lot of investors, because of the financial crisis, were taking out their money from financial markets and investing it in commodity derivatives or in commodities. And this actually was driving up. The food prices. So if you read, you have a lot of articles saying, okay, these traders, produce hunger in the world because they drive up these commodity prices. Food commodity prices. And it's true that a lot of people believe that the Arab Spring, so all these revolutions that you had in the Arab world that started in 2011, that this was mostly triggered by an increase in the wheat prices. And this increase in the wheat prices was caused by the financial crisis, okay? Indirectly caused by the financial crisis, because as a consequence of the financial crisis, people take their money out of the stock market, invested in commodities. This drives up commodity prices. This makes it much more difficult for people in the Arab world, which have a lot of their calories coming from wheat. So it makes it much more difficult for these people to live decently, because simply the fraction of their revenues that has to go to food has increased, and that of course creates social unrest, and that people think is the driving force behind these Arab revolutions. Okay, but if this happens now with the increase in wheat price again because of the war in Ukraine, we could see some very, very tricky situations. The situation in the world could really become complicated if you have not only the war in Ukraine, and not only an increasing volatility in food supply because of climate change. So climate change hasn't really depressed the food production, but it makes food production very risky. You know that in China, for example, you have massive rains, and that has really last year, and that has really depressed the wheat production in China. Similarly, in Australia, you have massive floods, and then you have dry periods. Okay, so climate change increases the volatility of weather, and that's not good for farmers. So all of these factors could, end up accumulating into a lot of turmoil. So let's hope that the wheat traders are correct, and that the war in Ukraine ends before the planting season starts in a couple of weeks. So far, there's still snow in Ukraine, but very, very soon you'll have spring, and then if all these people, I mean, there's 3 million people now fleeing out of Ukraine. Somebody has to plant the wheat. Anyhow, okay. So that's the introduction. I don't know if you have. I mean, we only have 2 hours, so it's maybe not worthwhile to have a break. Let's maybe just move on with the next chapter here. So the next chapter, I wanted to introduce the way to trade financial derivatives on commodities. Okay, so I wanted to talk about these forward and future contracts, which are the basic financial commodity financial derivative that you use to trade commodities. And I want to talk a little bit about the mechanism of trading in these future contracts, and how are these future contracts actually linked to the underlying commodity. Okay. Now, what is a forward contract? This is the more simple. So you have futures and you have forwards. Okay. A forward contract is something very simple. It's a contract that is conducted now, concluded now, about a transaction that is going to take place in the future. Okay, so if I buy a forward banana, okay, so I talk to a seller of a banana and I say, okay, here I promise you I will buy a banana tomorrow and I will pay this banana tomorrow. Okay, that's a forward contract. Okay, it's simply a transaction that is concluded today but takes place in the future at the price that is already concluded today. Very simple thing, and something that a lot of people do all the time. So nothing special about forward contracts. Okay, and forward contracts can be done on a one-to-one basis between individuals, companies. So companies do this a lot. They just contract with, for example, if you are a coffee producer or coffee roaster, you can just talk to a coffee producer and you can say, okay, I need, next month I need 5 tons of coffee. Can you deliver? What is the price? And the guy says, okay, I have coffee. I delivered it in 5 months. Here's the price. Let's conclude the contract. Okay. And then in 5 months, he will deliver the coffee and you will pay the price. Okay. Now, the problem with forward contracts is that they cannot be traded. There's no price discovery. Okay, they are not standardized, and forward contracts are very risky. Okay, for both parties actually. So why are forward contracts very risky? Let's think about again the situation of this coffee roaster. Okay, he needs. I'm making this up. He needs 5 tons of coffee in what did I say? In, let's say, 6 months. In half a year, he needs 5 tons of coffee, and he has, talked to this coffee producer, and they looked at today's coffee prices, very high coffee prices today. Okay, so he says, okay, based on these prices, I conclude. I don't remember what the numbers were. I conclude a contract. Let's just to make it more realistic. Coffee, let's take Robusta, 10 ton. Okay. I need 10 tons of Robusta coffee in 6 months. Sorry. The price is $2,000. Okay, so okay, we could conclude on $5,000. Okay, you promise that you're going to deliver to me 10 tons of Robusta coffee, and I will pay you $2,000. Okay. Now, I'm not sure that this is the 10 tons. It's probably a price per ton. Okay. Let's we clarify this later. Okay. The point I was trying to making is that the forward contract is very risky. Why is it risky? But assume that prices go down, and 6 months from now, okay, actually the coffee prices are much cheaper than the price I agreed on today, okay, 6 months before. As a buyer, I will look stupid, okay? I have concluded this very expensive contract, and now I could just buy 10 tons of coffee on the market for half the price. Okay, what will I be tempted to do? I will be tempted to get out of the contract. Okay, so I will say, okay, I will call a lawyer and say this is not really your signature, or actually this is an illegal contract, or I will pretend they don't have the money. Okay, for some reasons I'll try to get out of the contract because I know that I can buy the same amount of coffee much cheaper today on the market. Okay, so actually I will default as a buyer on my side of the contract. The same risk can of course happen to me as a buyer. Okay, so the seller can also a default on the contract. In particular, if the coffee prices is going up. So the guy, he agreed on selling the coffee for a price of 2,000, but now we have a price of 4,000. Okay, he will be tempted to claim that the warehouse has burned and actually he cannot sell you the coffee anymore because it has all gone up in fire. Okay, in reality, of course, the thing he's doing, he's selling the coffee for $4,000 instead of selling it to you at the price at which you had agreed 6 months before. Okay, so in other terms, these forward contracts have come with a huge default risk because in terms of market values, given that you fixed the price a long time ago, at the moment of the delivery, the current price can be very different from the market price. So one of the parties will look stupid. And the party that looks stupid, so either the party that has been buying for a too high or the party that has been selling for a too low price, will be tempted to get out of the contract. And then, of course, you end up having a problem. You have to call your lawyers. You have a disruption of supply. The roaster, he needs the coffee, but it's not being delivered. You get into, unnecessary complications and unnecessary transaction costs. Okay, so that's why people invented future contracts. Okay, future contracts are similar to forward contracts. Okay, but the difference is that a future contract is not concluded between two companies, but there's always an intermediary, which is the future exchange, or more specifically, the clearinghouse that comes with the future exchange. Okay, with whom you will conclude the contract. Okay, so you will have the buyer who buys the commodity through a future contract from the clearinghouse, and if you have the seller who sells the commodity to the commodity to the clearinghouse. Okay, and so there will be no direct contact between the buyer and the seller. So normally you will not even know from whom you will buy the coffee in the end, because you have contracted with the exchange and not with the ultimate buyer. Okay, and then you have, of course, mechanisms that are supposed to make sure that both the exchange has a big amount of money and he has reputation for not defaulting, but even the buyer and the seller, you have a mechanism that makes sure that they will not default on their future contract. Okay, and that mechanism is daily settlement. Okay, so which means that if the prices go up or go down, the clearinghouse will calculate what are the theoretical losses or profits that the buyer or seller has realized, even if the actual transaction is going to take place in 5 months. If today prices go up, actually the buyer will have made a profit because he had locked in a low price, and the seller will have made a loss because he has locked in a low price as well, and he could sell at a higher price. So you will have, when prices change compared to this price that has been fixed on this future contract, some parties will make a loss and other parties will make a gain, and the clearinghouse will require that if you made a loss, you immediately pay to the clearinghouse the money corresponding to this loss. And if you have made a profit, actually you can take out this money from the clearinghouse immediately. Okay, so that makes sure that there will not be a big loss or a big gain at the end, but that as soon as prices changes, there will be small losses or gains. So it's much less likely that one of these counterparties will default on these small losses or gains compared to the large losses or gains they would realize at the end of a forward contract. Okay, so this is the daily settlement mechanism, and this daily settlement mechanism is there to guarantee that nobody defaults, because as soon as prices change, you will have to come up with the money for your losses or be able to get the money for your gains. And if you cannot come up with the money, the clearinghouse will make sure that you have deposited some money in the clearinghouse that they will use to compensate for the losses, and then they will cancel the contract, okay, so that you cannot realize any future losses that you may not be able to pay, okay. So let's compare futures and forwards in a table, okay. Basically the same idea, contracts about a future transaction at a price that is already fixed now, but that will be paid in the future, okay? But forwards are, over-the-counter contracts, just negotiated between a buyer and seller, okay? Whereas futures are traded on organized exchange, and we will see this in a minute. They use standardized contract terms, because if you want, you don't know who's the seller, who knows the buyer, so everybody needs to be able to sell and buy the same type of product. You have a clearinghouse that guarantees that the payments will take place, because the payment will not come from your counterparty, it will come or go to the clearinghouse. You have daily settlement in futures, so losses don't accumulate, they have to be immediately accepted or compensated. And futures contracts, you can also close out on future contracts. I mean, again, this is something we'll see in a minute, but a forward contract, let's suppose you buy your 10 tons of coffee, and in the end you decide that actually you don't need your coffee anymore. This is a problem. If you have a forward contract, there's no way or no good way to get out of it. If you have a future contract, you can just sell this contract again. You can find somebody else on the exchange who wants 10 tons of coffee, and you will sell the contract to buy 10 tons of coffee to somebody else, okay, who might be interested. Of course, not at the same price. So, I mean, potentially you have to decrease the price so that you find somebody who is interested in buying these 10 tons of coffee. But the important thing is that if for some reason you don't need your coffee anymore, you have a way of getting rid of this this contract that says, I will buy coffee from you in the future. Okay, so that's close easily. Forward contracts, you cannot close them. Futures contracts, you can get out of them. Regulated, yes, okay. As all financial markets, futures contracts are regulated, as I said, not by the same regulators as the financial regulators, and therefore there are quite big differences between how financial markets are regulated and how futures are regulated. But then, okay, the downside is, of course, that the futures contracts are less flexible. So, I mean, you have normalized qualities, you have normalized products, and you have normalized quantities. And there's a lot of commodities, obviously, that don't trade on future contracts. For example, olive oil. Olive oil is a very important commodity in Europe, and people have tried several times to introduce future contracts on olive oil, and it just didn't work. Nobody wanted to use this. So olive oil is still traded today with forward contracts, not with future contracts. We can discuss about the reasons, but it seems that it was not possible to construct a future exchange on olive oil, despite the fact that there's lots of olive oil being traded, and that, for example, soy oil is something that, or cooking oil, is something that is traded as a future, and these are very efficient contracts. Olive oil, for some reason, didn't work, and I know that even in Vietnam, I think they tried to construct a futures exchange where you would be able to buy and sell rubber. So that didn't work. There was just not enough people that wanted to use that. And I think also Pangasius, the fish. Okay, so I think that's another big fish, another big Vietnamese export, and it's a fairly standardized product. But apparently the introduction of future contracts in these markets didn't really work. So that means that today you still have to trade in forward contracts with all the inconveniences that come with that. No way to be sure that your counterparty, honors the contract. No way to get out of your contract if you don't need these commodities anymore, and so on. Okay. Now, so how does a future contract look like? Let's just look at the wheat future contract at the Chicago Board of Trade, which is the big US trading house for futures. Okay, so they trade historically. They have been founded in the 19th century already. Chicago was really the center of the US. A lot of railways, stopped in Chicago. A lot of rivers went to Chicago, so it was easy to bring stuff to Chicago and to take it away again. So that's why they started these historic future contracts in Chicago. And even today, I mean, most commodity futures are traded in Chicago at the Chicago Board of Trade. And they are traded with these historic contracts. The wheat contract we see, it's quite a strange contract, but I mean, that's it. That's the way it's done. So this is the standardizing of, these, as we said, because you don't know who's the seller. You need to trade this on a market. It needs to be extremely standardized. So this is the standardization. So the quantity of one contract is 5,000 bushels per contract. Okay, and actually that's historically, this comes from the fact that the wheat was transported in boats, and one boat basically was able to contain 5,000 bushels. Okay, and bushel is actually a volume measure, but today it's expressed in bushel is expressed in weight. Okay, so that's a bit surprising, because actually a bushel of wheat, okay, a bushel of wheat is 60 kilogram, but a bushel of corn is only 56 kilogram. Okay, and the bushel of oats is that's not kilograms, it's pounds. Sorry, pounds. Is 32 pounds in the US and 34 pounds in Canada. Okay. It's a huge mess, okay, for Europeans, or even for you. I mean, we have the decimal systems, so that makes things easy. But in the US, the historical measures are a huge pain. But given that this is how these contracts are specified, this is what you have to use. So if you have a bushel of a certain commodity, you have to remember that this doesn't correspond to the same weight of the commodity, because it's actually originally a volume measure. But bushel of wheat is 60 pounds, so these are UK pounds or British pounds, so it's not exactly half a kilo. The whole thing is a mess. Okay, but anyhow, that we can manage, but it makes life a little complicated. Okay, so then you have the quality. Okay, so these are the different wheat qualities that can be delivered as if one of these contracts expire. Okay, and the contracts can expire, though you have 5 different months. Okay, where you can buy wheat. Okay, so you can buy, for example, a September 23 wheat contract. Okay, if you buy a September 23 wheat contract, one contract, you basically agreed to be delivered at a certain date in September. Okay, we'll talk about this. So the date is specified, but in early September, a date. If you buy this contract, you have agreed on buying in early September 5,000 bushels of wheat of this kind, okay, of this quality. Where do you buy the wheat? But that again is specified. So you have a number of approved warehouses that are all located in Chicago. Okay, and actually, whoever is selling the wheat to you can deliver or needs to deliver the wheat to one of these warehouses. Okay, so if you buy again one wheat futures contract on the CBOT, you have to specify the date. That's it. Okay. So you buy a September contract, and then when the contract expires, you will be delivered 5,000 bushels of wheat of one of these quantities in one of these warehouses, okay? And you have to go there and pick it up, okay? So delivery, any business day in the delivery month, so that's September. Seller received the payment and delivers a warehouse receipt to the buyer. Yeah, so that's what happens, okay? So actually the seller may have already deposited the wheat in one of these warehouses before, and then he gets a receipt, okay, a sheet of paper that says whoever has this sheet of paper has the right to take out 5,000 bushels of wheat from this warehouse, and he gives this receipt to the buyer, and the buyer can of course then go to the warehouse and take the wheat, okay? Now the price of this contract is given in cents per bushel, okay? So it's not the price of the entire contract, it's the price of one bushel, and it's not expressed in dollars but in cents, okay? We'll see all of that in a minute, how it works out, okay? Then you have these daily pricing limits. This is just, if prices jump too much, then the trading is suspended. That's a usual thing, even in financial markets, okay? And you have the trading days, so it's in the morning. It's in the morning from 9:30 to 1:15 and Chicago time. So it's a pretty convenient business if you're a commodity trader. You can take your afternoon off. So the trading is only something like 4 hours, and that's it. Okay. Now, so that's one contract. Now, you have a lot of detailed regulations that says, okay, in principle, you have to deliver, number 2 soft red wheat, okay, or number 2 dark northern spring, okay. But actually, you can deliver something slightly different. If you deliver something slightly different, we will make an adjustment to the price, and this adjustment is called the delivery differential, okay? But this goes really very much into detail. And then you can also deliver the wheat not to one of these warehouses in Chicago, but maybe to another warehouse that's a bit further away. And if you deliver it further away, it's going to cost more for the buyer to get the wheat, okay? So you also have a location differential, okay? So if you deliver to the Chicago warehouse, you will be paid the full price. If you deliver to another warehouse that's a little bit further away, but actually the buyer will get a lower price because it's going to be more complicated for him to pick up the wheat there, okay? So here you have these quality and location differentials, okay? So if you have a premium grade, then you will actually pay 1.5 cents per bushel more, okay? So for example, if the contract says $3 per bushel, you will pay $3.015 per bushel, that's 1.5 cents more. Par grade, that's the normal grade, so that's number 2 yellow, okay? So this was no, it doesn't show up here, okay? For some reason, number 2 yellow is not here. It's number 2 soft red. I don't know why, okay? But par grade is normally the one that is specified. And then you have the lower grade where you would get a price advantage, okay? So these are the adjustments, okay? And here you have the different locations, okay? So you have the premium locations, you have the more expensive locations, and you have the normal locations, and that actually it's different. So I told you about the faraway locations. Actually, there are some locations that are more expensive because apparently more attractive for the buyers. Okay, so that's the way of quantifying a wheat contract. Let's go briefly to Bloomberg and check CBOT wheat. CBOT wheat. Where is it? Generic CBOT wheat. Okay, here, line chart. So this is the price we had. Okay, so what does the number mean? The number is in cents per bushel. Okay, so you can see that the last price is 1,071.5. No, three. It changed. Okay, this is a live screen. Okay. Oh, it go down, go up. Okay, interesting. Okay, you can see the prices moving. It's going down. Okay, we can see the prices moving as time goes by. But the current price is something like 1,069 or 1,070 cents per bushel. Okay, so 1,000 cents is obviously $10 per bushel. So given that one contract is 5,000 bushels, okay, you have to pay $50,000 for one contract. Okay, so if you buy one contract, you basically have committed to buying wheat for $50,000 in the delivery months. So the delivery months is, again, these 5 different months that we have here: July, September, okay, May. Okay, so actually the picture we have here is the so-called close by contract. So that's the closest delivery months we have. Now we are at the moment in March. And given that we are in March, the closest delivery, but actually there's a March contract, okay? So it's probably the March contract, or maybe the May contract if the March contract has already expired. We'll go into this in later. Okay, so the picture you see here is actually the closest delivery time. It's not the spot price. So spot price is what you would have to pay today to be delivered wheat today. It's the closest for future contract that you can buy. Okay, let me see if we can see how prices change in real time here. It's quite fascinating. Let me okay, I have to volatility trade price. Okay, okay. Option price. No, I mean, I will have to do this later, and then I show it to you. Trade quote recap. So here you have table. It's a bit difficult to understand. Okay, so these are the different transactions that have been taking place. But there's a problem with the timing. Okay, I'll figure it out and I'll show you tomorrow. But we should be able to see the live evolution of the prices for these types of contracts. Okay, so that's one contract. Okay, and that gives you an idea of the contract size. So we said something like $50,000. $50,000. If you buy one contract, you are committed to buying $50,000 of wheat. So these are not retail traders. These are professional users. So you need to have quite a bit of money if you want to play in these markets. Now, another more fun contract, maybe the famous live cattle contract. Okay, so what is the live cattle contract? I told you that's the cattle that you can slaughter. And actually, despite the fact that it's called live cattle, you may also already deliver slaughtered cattle. Okay, but you have to deliver 40,000 pounds of cattle. Okay, so that's one contract size. Okay, and then you have here again the definition of the quality of the cattle. Okay, you have the livestock yards where you can deliver the cattle. Okay, again, some of these livestock yards come with a lower price. South Dakota, apparently nobody wants to go there. Okay, you have the contract months. So you have again 5 contract months, not the same as for wheat. And you have the price quote, which is in dollars and cents per 100 pounds. Again, totally confusing. Okay, it's in bushels for wheat. It's in dollars and cents per 100 pounds for live cattle, but I mean, then one contract is 40,000 pounds. Okay, and the price indicated for for 100 pounds, you have to divide by 100 and remultiply it by 40,000 to know how much is actually the value of one contract. But here you have the delivery point for live cattle. Okay, so this is one contract. I think something like 30 cows. Okay, we'll do calculations later on that. This is 30 cows that have been delivered to one of the livestock cattle by the seller of a futures contract. Okay, and if you have been buying the futures contract, you will go there with some cowboys, okay, and you pick up your herd and you take it away. So that's the livestock cattle. Let's check the cattle prices just for the fun of it. Okay, so this is the CBOT contract, I guess. Again, no, the CBOT corn. So this is corn. This is I know why we had a problem here with the quality differentials, because the previous contract was about wheat, and the quality differentials, they were about corn. So it's not the same thing. Wheat is red and corn is yellow. That's why. But the principle is the same. So this is the CBOT live contract, I guess. Let's look. Live cattle. Yes. Yeah. So this is the first contract. That's the closed buy. So let's look at the cattle for delivery in April. Okay, April 2022. And how much does it cost to buy live cattle? Okay, so the price is 140. Okay, now what does 140 mean? 140 okay, so I'm not sure it's the same. It's the same contract. Okay, it's COMB. Let's check. Okay, so 140. If it's the same contract, it should be the price of 100 pounds of live cattle. So that's about $1.40 per pound. I think that's a reasonable price. Okay, it's cheap for meat, but I mean these are entire cattle, so have lots of bones and stuff. Okay, so given that this is the price for 100 pounds, what is the value of one contract? Maybe I should ask you to make these calculations. You're typically better than I am. So if 100 pounds of live cattle cost $140, okay, what's the price of 40,000 pounds? As I said before, we have to. Okay, I'll boost up Excel. It's too complicated for my brain. We have to divide by 100 to get the price per pound, and then we'll remultiply with 40,000 to get the price of a contract. Okay, so 140 divided by 100. Okay, this I could have done in my head, and then multiplied with 40,000 because that's the size of the contract. Okay, so again, you see it's in the range of $50,000. Okay, so $56,000. So I hope you can see what I'm doing here. If not, please complain. And again, please complain through the Nikken price. Nickel price. Good point. Yeah. Thanks. I have to do this. Frankly, you have to jump in and call me out, because the text you're writing here is disappearing behind some box, and I really don't see it. I have to really search for it. And also the screen is really very small. I should have maybe pointed this out to me. So I was trying to. Now the discussion has disappeared. Okay, I'm not really good at that. Okay. Why the discussion is still a discussion public? Okay, here we go. So live cattle. Okay, so $56,000 of cattle. you have committed to buying cattle, about 30 cows, I think, with a value of $56,000 if you buy one of these live cattle contracts, okay? And then you have to pick it up in one of these stockyards, okay? Quite fun. So this is just another Bloomberg example when we didn't have Bloomberg directly, okay? What time is it? So we're almost out of time, okay? So did you already use WooClub in one of your earlier classes? Because if yes, then we could communicate a little better through WooClub. Okay, did you use WooClub? WooClub is a system where I can ask questions and all of you have to reply to it. Very convenient. Okay, and no, we did not. Okay, so I'll try to set up a WooClub questionnaire for tomorrow at 1 o'clock. For tomorrow, and it's going to be an interesting way for you to for me to check if you're understanding what I'm saying, and for you to participate in the class without talking, because that's apparently what you want. And it could be part of the participation grade also for you, because I can see what your answers are. So okay, let's do this now, next week. I have to set it up, so it's going to take some time. And in the last minutes, let's check what happened to the nickel prices. Okay, a big scandal indeed. I had forgotten about this. So there was a short squeeze in nickel at the London Metal Exchange. Nickel. Let's see. Okay, and they decided at the London Metal Exchange to actually cancel all the trades. Here you go. That's a nice price evolution, except that you can see that actually the actual price evolution was more impressive than that, but they decided to cut everything that exceeded this level. You can see here what's going on here. This is not for you, and this is not for you either. Okay. Let's go back here. What is okay? Where's the course web page? Sorry. There you go. Yeah. So this has created a bit of, so there's two problems here. The first problem is, of course, that it's not normal that the nickel prices increase so much, but the reason for that is actually the war in Ukraine, because Russia is not only a big oil producer, but also a big producer of nickel. So I mean, the increase, part of the increase in the nickel price could be explained by the fundamentals, but part of the increase in nickel price is also explained by the fact that you had a big Chinese nickel trader who was speculating in price decreases. So he was caught off guard by this as everybody by the Russian war, and he lost billions because of this price increase. And by actually canceling all these transactions that took place at very high prices here, the London Metal Exchange basically saved this Chinese trader. And of course, I mean, because they saved this trader, they removed a lot of gains from a lot of hedge funds that actually had thought that they had made huge profits, but in the end they got their contracts cancelled. Okay, so there's a big discussion about whether this is really fair or not, because I mean, you have this trading venue, and I mean, in principle, when you're trading a price, I mean, that's exactly the point of a future exchange. Remember that there is no default, but in this case there was default. because the future exchange itself decided that this was not a normal price evolution, and that they had to do something about it, and they had to basically save this Chinese nickel trader. Big story indeed in the markets. I can find out more what happened, but I think it's a basic short squeeze. So we'll see how this works next time. Okay, so thanks for pointing out that Canvas has a tool for questions and answers. I will try to find out how this works, but frankly, WooClub is pretty convenient, and you can use it easily without Canvas. So let's see which one is better. I try to understand how the Canvas tool works. I haven't used it yet, but one way or the other, I think it would be good to have some exchange and to check whether you're following, and you have do little calculations and little multiple choice questions, so that you are not lost, and I can see that you are lost or not lost. Okay, so let's stop here for today. Okay, so again, sorry for the late start. I won't start late tomorrow, and we continue with that tomorrow. We continue talking about what is the structure of these future contracts.